Thank you, Alex, for having me here, and thank you to the Trading Pit for just sharing this phenomenal platform you guys have, and tremendous community you have built here. It's a great to have a chance to share that, and once again, it's great to have the opportunity to bring awareness to causes out there. I spent, as I'll talk about shortly, almost 9 years as a United States Marine, and there are, there are many causes as we're in the holiday season. Those of us who have been blessed with the opportunity to be in the markets in either a principal or a minimal capacity, it's important that we give back. And I just thank the Trading Pit for allowing me to share my perspective on the markets and also bring awareness to important philanthropic causes. So thank you so much, Alex, and thank you to the Trading Pit for that.
And thank you for being here, John. Thank you for the kind words and being here with us.
Absolutely. So I'm going to go to the share my screen functionality here, and just bear with me because I've not done this before on Zoom. And so do you share screen? Oh, here we go. Duh. Okay, got it. Whiteboard, Zoom, Trading Pit. There we go. Perfect. Okay, perfect. All right. I'm gonna go to that. Go to view, go to read mode. There we go. Okay, that should, so it's not, now I'm sharing this. Excellent. All right, so listen, everyone. This is part of a 5-part webinar series, and this just, can't even begin to express how excited I am about just laying the foundation over the next 5 webinars about how to address both the current dynamics of what the markets are and where we all sit in that. A little bit about me first. As I talked about, I was a U.S. Marine almost 8.5 years. I've been around the capital markets and trading for 25 years, going back to when I was a U.S. Marine stationed in Japan in 1998, 1999, working in the U.S. Embassy, was in the markets. In fact, when I grew up in high school, I ran I was a liquidity provider for those wishing to prognosticate on the outcome of sporting events. So yes, I was a bookie back when I was 14, 15, 16 years of age. I wrote The Global Macro Edge. It came out in 2016, literally within a week of my daughter being born. My daughter now, Octavia, she's now 7. I'm, a husband. I'm married to an amazing Greek wife, which Alex practices his Greek with every time we get together and talk. It's phenomenal. And I'm also a full-time law school student. And so there's a lot of perspectives that I've gained, when I've combined, I'm now my 2nd year of law school. And it's just, I think it's made my appreciation to understand the capital markets even greater, incorporating what's been, a lifelong dream of mine to become an attorney. And I can't wait to, I still have 2 years left, but when I become an attorney, to implement, all my experience from the capital markets on top of a legal education to just further help investor advocacy and help veterans and help people out there, because the law, both within a U.S. domestic perspective and a broader perspective, is a very powerful tool to do good things with. And then, having the benefit of serving in the United States Marine Corps, I speak Japanese, Chinese, Portuguese, and Spanish. I was stationed in Japan for 4 years. I spent 2 summers in China, in Beijing, actually, the Beijing Language Institute, learning Chinese. And then my grandparents are from Portugal, and of course I'm from California and New York, so there's a Spanish component there as well. So a quick perspective on just what I'm all about. And again, I talked about, the Trading Pits platform, really appreciative of that, and the charities in particular. One charity that we donated a good chunk of the Global Macro Edge to was rebuildingwarriors.com. We ended up helping donate 8 service dogs that went to military veterans with a post-traumatic stress disorder and other neuro issues that they were facing. And we're just very appreciative of that charity, etc. Okay, so let me bring in a quick law school analogy about how this has helped me, and then we'll get on to building a business plan, which I've laid out some specific aspects. And again, there's a PowerPoint deck to this. So if you guys have any questions on this, of course, we have a component at the end. We'll get to that, but really quickly. So how does law school help me understand the markets better? Well, in one situation in particular, you'll hear this from most attorneys, if not all attorneys, and that is evidence wins cases. All right. The more evidence you have to support your case, the more likely you are to win. That's pretty intuitive. Nothing crazy there. There's also what's something that good attorneys do, and my professor calls it the C+ answer versus the A answer. And the C+ answer addresses risks almost superficially or topically. The A answer really addresses risks at the details, at the margins, every incremental edge I can get in a case, every incremental edge I can get in a trade, an investment, whether it's the exchange it trades on, whether it's periods of the day where there's illiquidity aspects, whether it's the software that I use that helps me gain that little bit of an execution edge. If I can get even 0.5%, a 1/10% edge, these little edges, right, come into play. And so it's in the same way you don't, when you're advocating on behalf of a client, you want to do what's called eliminate escape hatches. So I want to kill off arguments that my opponent can make and be ready for those and basically pin them in and suffocate them and then win the case. And that sounds a little predatory, but it just is what it is. In the same way with the market, okay, I've covered this and I've built this option exposure to hedge that. I now have covered this in terms of my business costs. I've covered this. So it's very interesting to see those now. And lastly, what I call, and I talk about this in the Global Macro Edge, specifically chapter 3. So if you get an opportunity, I highly recommend emailing the Trading Pit and getting a copy of those first 3 chapters, because I talk about endogenous versus exogenous alpha. And so there's this big debate, or there's this big understanding of, or this bifurcation of procedure and substance, okay, in the law, all right? And that is, there's a procedural issue, i.e., how many days you have to file, what the court terms that have, limits your briefs to, what one state's law is potentially, or how you would adjudicate a matter. And the markets, the same thing applies. So let's think about procedure versus substance. If I trade futures, okay, and I put on the same market opinion on futures versus 3 big caps tech stocks, there's a tax advantage for me trading futures versus trading those stocks. There are other ways in terms of how I get data, all right? I may find a way that we all know just how expensive data has gotten. And I think one of the great parts about what the Trading Pit is the ability to access real-time market data at a fraction of the cost, potentially, compared to some other configurations out there. As someone who's invested in the past very heavily in trading software, I can attest to just, if you ask anyone that subscribes to the CME, they can tell you just what data prices have done in the last 3 to 4 years. ICE is the same way. And so if you can get your data, that's a procedural edge. And I can tell you one thing, having been around the capital markets for 25 years, going to law school full time right now, that your costs, okay, like live within a means, okay, because the more costs you have, the more pressure you have. And this is all part of your business strategy, the business plan, which we're going to talk about today. So I'm hitting you guys pretty hard here, but I lived in Manhattan for 8 years. So I speak a little fast. It's because I love this stuff, and I'm just really thrilled with the opportunity to share with you guys today. So once again, thanks to the Trading Pit. Okay, so let's hit the meat of this topic today. All right, and that is, what makes a trading strategy appealing? When you build your business plan, all right, when you build this business plan, what are the things that you should be asking yourself? Now, a lot of us think, and understandably, and this is very intuitive, is that the first thing that stands out is, all right, can I make money with this thing? But that's a one-dimensional perspective. And the Global Macro Edge, we really take a 3-dimensional approach, okay? So we're going to get into a little bit of this today, but really we're going to cover this over the next 5 webinars about what that 3-dimensional approach encompasses and what that entails. So for today's purposes, we're going to just touch briefly on the first thing about what makes a trading strategy appealing. It's viability, and I'm going to break this down on the subsequent slides. The second thing is its liquidity. What's the liquidity of this strategy? The third thing, how well does this strategy scale? The fourth thing, the drawdown, its overall volatility. The fifth thing I'm going to touch on is, what is implied risk and how we measure implied risk, or at least we'll broach the concept of that today before later webinars delving into that even further. And then lastly, this gearing leverage capacity. So what, if I have a strategy, how much can it be leveraged? And that's going to be a function of the previous 5 points right there. And then I'm hoping to get to, if we have time, the next 2 weeks of market action to kind of outline for you guys how I apply the concepts of the Global Macro Edge to this webinar. And then lastly, we have an attendee Q&A, but I live here in Las Vegas, and my daughter starts school at 8:55. It's 8:13 right now. So, I'm a husband and a father, and I have another one on the way. So I take my dad time very seriously. And it's why it takes something special like the Trading pit to really come out and do something like this because of just this platform to share with all of you great people. Okay, so viability, the first thing of the 6 that we talked about. So the first question when you build a strategy, it's not necessarily the first question, but it's an important question. It's right up there, and that is, what is the viability of the strategy? And I'll give some examples from my 20 plus years in the capital markets. So is this a strategy that you see has longer term viability, meaning that 1 year or longer this can play out? Okay, and that's a function of fundamental analysis. That's a function of maybe some technical analysis, now dynamic of money flows. So if you think, for example, that we're going to be in a low volatility environment, okay, for the next year to 2 years at least, okay, given obviously that there's limitations on the foreseeability behind a certain investment climate, but nonetheless, we still want to make assumptions and see what evidence we can proffer for those assumptions. So if you think that your strategy has a long-term viability, that influences how you map out your costs, that influences how you want to allocate the strategy. It influences maybe what your risk budget is, okay, which we're going to talk on towards the later end here. And for like a 1 year viability, is it, listen, I think that we're in an environment where the Fed is going to keep rates low. As long as if it keeps rates low for the next year to 2 years, it's tough to say beyond that. We're going to see a VIX between 15 and 19. And as a consequence of that, any pullback in the markets of, let's say, 7%, I'm being very general here, is something to be bought because given the perpetual low volatility, given these other factors, this strategy should work over that time period. Talk about medium-term viability. All right, I think that this can play over the next 6 to 12 months. So in other words, there may be something that you see in the markets, or there may be something with the technical aspects of your strategy. Say, okay, I think this works medium to long term, and more importantly, there's a short-term viability, meaning, okay, there's an event coming up, there may be an election, there could be, the market's oversold, there could be some new rule that just happened, all right? And there's some component driving that, listen, I don't know the longer term how this is going to be, but from a short-term viability perspective, I see this being good for 3 to 5 to 6 weeks. And when you think about what the trading pit is about, the trading pit is about finding talent, okay? It's by taking someone that maybe doesn't come from a Wall Street background, but nonetheless, has the ability. And when you have this digital world that we live in, it's a chance to go out and source talent that maybe didn't go through a 10-year Wall Street history or didn't work at a hedge fund for 7 years, but still has the skill set, still has the temperament, still has the disposition to prove itself. And so the first question, if I'm thinking about my progression, if I'm thinking about building a business plan around my trading strategy, is, can I articulate the viability behind this? And you can have subcomponents to where those subcomponents comprise, okay, listen, I have 3 subcomponents that make up the short-term that I think have short-term viability. I have 2 subcomponents that make up the medium-term viability, and I have 1 subcomponent that makes up the longer-term viability. Or as you source these, and then you can also talk about, as you're building your business plan, what you do to reassess these things of viability. Do you reassess them every 2 weeks if it's a long-term viability call? Do you reassess them every 2 days if it's a short-term viability call? What are your parameters? What is your metric for that? And these are things that we discuss in the Global Macro Edge. And these are things that, as you think about your career at the trading pit, as you think about trading well to earn that capital allocation the trading pit gives for people who, based on merit, demonstrate trading skill, this is one component that the ability to articulate that, I think, puts you in a great spot, not only for your own sort of endogenous development, your own organic development, but when it comes to articulating and developing a relationship with the trading pit as well. Okay, number 2, let's talk about liquidity. And this is definitely a factor in terms of liquidity. The products we trade and the times that we trade them at, really matter for assessing liquidity. What kind of a turnover do you have? And this is going to feed into the next one, the next component here. So for products on the trading pit platform, different times of the day see different liquidity components to that. And if you're a person that wants to go from running a $500,000, $200,000 account to a $10 million, $20 million, or $50 million account, the liquidity behind those products matters, and that impacts your business plan. If you're going to build a business plan where you're going to earn a certain percent of the profits, okay, if you trade your own capital, all right, well, you're taking 100% of the risk for 100% of the profits, conceivably, okay? There's business costs and tax consequences as well in there, but we'll set that aside in this theoretical vacuum for a moment, okay? So that liquidity plays a big factor when you think about your business plan. You think about what it is that you're going to scale it, because if you have a really, really high return strategy, it may make more sense. And that strategy doesn't lend itself well in liquid markets, then it may lend itself to set up a certain structure in terms of if you're going to build a business plan around that, to where maybe you manage less money, but you also maybe work for a different payout, because there are some capacity constraints, and those capacity constraints are determined by the liquidity aspects there, okay? The trading times, maybe you trade in the morning, maybe you're trying to work into this because you currently have a full-time job, or you have a part-time job, and that job impacts, it helps you pay the bills, so you don't have the pressure of trading expenses, which, I mean, when you think about doing this on your own, you have bills to pay, you have rent to pay. And like I talked about, I mean, listen, I'm featured in Market Wizards. I've made millions of dollars factually in my career, many millions trading the markets, okay? I drive a car that's 6 years old, okay? I live in a humble home, all right? I don't live a flashy lifestyle. Financial literacy is big, okay? And I pride myself in that, all right? I pride myself I don't have 5 cars or 4 homes, okay? I like the way I live. I love that I go to law school. I love that I maintain my objectivity when it comes to managing my portfolio, when it comes to looking at the markets, and I'm growing. And so I would emphasize that the flash and the pomp and it creates more pressure. And the investments you make are ones that aren't seen. The investments you make are in investment research, trading research, building relationships, traveling to meet other like-minded people, developing those things. Those things that don't show up, maybe in a bigger house or a better car, a newer car, those things can really have a profound impact on your trading P&L and keep you centered, keep you grounded. And that's what I emphasize. I mean, I'm a husband and a father and a dad, and my faith. Those are the things that drive me and drive what I do. And if you have that grounding, I think it's beneficial, and you end up getting featured in Market Wizards one day. So boom. All right, scalability. Okay. What capacity does the strategy have? Okay. And so this is something that, again, if you're looking to build a business plan, think about what you're doing, and then go through the last 10, 20, 50, 100 trades, all right? And think about, are you trading at 3x, at 5x? If I was to put the same trade on with 10 times the size, what would have happened? With 20 times the size, what would have happened? And you should be able to answer, I mean, make an educated guess. Again, we talk about evidence. We talk about, closing out escape hatches. We talk about, mitigating risk, okay? What would happen if you put on that trade at 10x the size? What would happen if you put on the trade at 20x the size, okay? What's the impact on that strategy? If you haven't thought about that, then you need to go back and do more work on your business plan, okay? Because this scalability is something that really, and the fact that you've thought about the scalability really shows that you're ready to make the next leap as a professional trader and to spend a career in the capital markets. And that you can then, all of these things help establish your game plan, helps establish, what your next step is. Boom. Okay, drawdown volatility. All right, this is something that, man, I spent a lot of time in the Global Macro Edge talking about, the book is named The Global Macro Edge, Maximizing Return Per Unit of Risk. And that's right, return per unit of risk. So what does that mean, simply summed up? It means, how do I make more while risking a little? All right, how can I risk a little to make a lot? Okay, and what's the process of that? Because a lot of people out there can risk a lot to make a lot. A lot of people can risk a lot to make a little, but how do you go about risking a little to make a lot? And the first way that you do that is you need to understand, what the volatility of a portfolio is. That's not the only thing you need to do, but that's the first thing you need to do. And what's the volatility of this portfolio? What is this, my peak to valley drawdown? All right. And what are some of the realized risks? And then I'm going to spend a little bit of time here talking about the implied risk behind this. Okay. So realized risk would be, okay, in the last 3 years, I've had a drawdown. Remember, just to get everyone up to speed, by say a drawdown, I mean when an account goes from, let's say it has $100,000 in it and it falls to $90,000. Well, it means you had a $10,000 drawdown. Okay. And that realized risk is something that we see a lot of. And for those of you that are familiar with some of the institutional metrics out there, talk about the Sharpe ratio, the Sortino ratio, the Kalmar ratio. These are ratios that measure returns of a portfolio relative to the volatility of that portfolio. Okay, so this is something that a lot of institutional people pay attention to for good reason. Obviously, you don't want to have a lot of volatility to make a little bit. That's not something that's likely going to end very well. To the degree that you can, you'd like to have, a little bit of volatility to make a lot. Now, part of the problem, and this is something we addressed in the Global Macro Edge with those mainstream metrics, is that they only measure realized risk. What do I mean by that? They measure risk that happened as measured by the past. So, for example, if I had a 15% max drawdown last year, okay, that's measured. What we don't know in there is number 3, and that is the implied risk. In other words, what were you risking to actually get that number? And that's the question a lot of people don't ask, because the metrics out there, the Sharpe, the Kalman, the Sortino, are all based on the realized risk or the realized returns. In other words, what happened in the past. So one thing I think that you can do, not I think, which and again, you can learn about this more in GME and just asking a question here, or both, is, and I would definitely, again, get those first 3 chapters. They're absolutely free, the PDF of that. Email the Trading Pit and get those. It'll lay a foundation for you guys. But that is, what is my risk budget behind this trade? So, for example, if I give someone $1 million to manage, I give 2 people $1 million to manage, and I tell Alex, for example, Alex, here's $1 million, buddy. But if you lose $200,000, we're done. Okay, I got to yank the money. I have to manage the risk around. I'm going to give you a $200,000 risk budget, which means if this $1 million I gave you, Alex, ever falls to 800K or it's down 200 grand, I've got to pull it. I'm going to pull the money. I'm going to stop your trading. Correspondingly, there could be another manager who also gets $1 million, but he has no risk budget at all. He can lose, the account can fall to 800, down to 600, down to 500, down to 300, etc. He has no risk budget. So at the end of the year, okay, Alex's portfolio sits at 1.2 million. The other portfolio sits at 1.2 million. And let's say they both had the same drawdown. Let's say they both had a drawdown of $100,000. Well, guess what? If you use the Sortino, the Kalmar, and the Sharpe ratio, Alex, who had a 200K risk budget, and the other manager are going to look at, they had the same numbers, but they didn't, because Alex had to manage with what I call flexibility premium. Alex had less flexibility, and he managed within a risk budget. That's critical when it comes to understanding your scalability. That's critical when it comes to understanding, can you be invested in? We're going to spend a whole webinar on this actually in 3 weeks, or the 3 webinars. The first webinar started the new year off. We're going to talk about incorporating the Netto number, and that's just a beautiful thing. So, and to that topic, let me go over the webinars quickly, what we're going to talk about. On December 11th, we're going to go over constructing a trading journal. I'm going to go over what's chapter 8 of the Global Macro Edge, all the aspects, or at least many of the aspects of what's in a trading journal. On January 8th, which is going to be a great day to talk about the upcoming macro themes in the new year. I'm going to go over the Netto number in detail. I'm going to go over how I calculate the Netto number. We're going to walk through a couple of these examples here to give you a Netto number score, and then ultimately how that can play out even to what we created, the risk factor compensation system. This is all in the Global Macro Edge as well. On January 22nd, we're going to talk about and incorporate economic events into your trading. And then on February 5th, we're going to wrap up, actually may do one more beyond February 5th, but we're going to incorporate your intuition into your trading. And that's the one that we do some real soul searching into what your beliefs are, both limiting beliefs and expanding beliefs about what's possible for you, how that impacts the way you trade, how that impacts the way you execute. These are things that we dedicated a whole chapter in GME about that. We had the pleasure of Denise Scholl, who's very well known in circles. She's spoken around the world. She wrote that chapter 19. So we're going to talk about that as well. And this is something that, again, really, really key to keep in mind. So, in quick summary, okay, when it comes to building a business plan, all right, we're looking at these 3 things, or these 6 things. The viability on both a short-term, medium-term, and long-term basis. The overall liquidity of your strategy, which we talked about just again very topically. The scalability, and these are things that's something you want to look at in terms of how well the strategy scales. What assumptions am I making when it comes to assessing that scalability? We talked about drawdown and volatility in terms of what kind of volatility your strategy has. Are you currently tracking that volatility? What plans do you have for tracking that volatility? How does that volatility incorporate itself when it comes to making assessments of what you do? And then we talked about implied risk. What's the implied risk in your strategy? How much risk? So today, when you lost $2,000 or $5,000 trading, okay, but you were down a lot more, but you made a big comeback. Well, what were you really risking today? And what were you going to do if that level would have been hit or if it would have been stopped out? And we talked about ultimately the gearing leverage capacity, like how much, how can you be geared? And that's what the Netto number touches on. So let's go over now the next 2 weeks of market action, and hit on a few things before we sort of run out of time, and I got to rush my daughter off to school. So key market events for the next 2 weeks. One, we see this Thursday, U.S. core PCE. I can spend literally an hour talking about how the Fed is driving things right now and how we're just seeing a true reconciliation between what's happening with real yields, but we'll get into that later in future webinars. But on Thursday, November 30th, we have U.S. core PCE. On Friday, December 1st, the ISM manufacturing should move the markets. Those two have definitely had an influence on things. Tuesday, December 5th, mark this on your calendar at 10 a.m. Eastern time. I believe that's 3 p.m. Greenwich time. That's the JOLTS number. This JOLTS number has the penchant to really move things. That's the job openings and listings that come out here in the U.S. That's at 10 a.m. Eastern time. And then Friday, December 8th, we have non-farm payroll. We have unemployment and average hourly earnings. So those things I think can all really move the market, and something I'll be watching, and I'll give you guys when we come back in 2 weeks. I'll give you a recap of these events, very short recap. We have 36 minutes today, so I want to make sure that we delve into touch on everything, and also give you guys a chance for the Q&A, because the Q&A is really important. And maybe we'll even do just one session with just pure Q&A, or we'll really make it more skewed towards Q&A. Alex, what do you think about that? Like a session where we focus on maybe more Q&A and less substance.
Oh, well, I would say I was just thinking about that right now. Anyway, we're going to be dropping our emails, so there is not a problem at all. If somebody has questions, specific questions that they would like John to address you, I'm going to add my email. I can receive the question. I will forward to you, and we're going to come back. We're going to come back with a question.
Great. All right. So I've hit those events. We've got 4 or 5 minutes left, Alex.
Yeah.
And to agree, if you can start firing some questions from the audience, or I can review some things. Let me know what we
Yeah,
got.
so far there are not any questions. If somebody has a question, they can start writing in. The Q&A section is open for everyone. You can write the questions. At the same time, as I said, I'm going to be dropping my email as well. John, that was impressive. That was impressive, first of all, because I really like the fact that you are thinking big, right? So in order to go to that kind of the big level, how you're breaking it down. So I really like the realistic approach and the modest of your personality as well, because in order for us to succeed in trading, our goal and target indeed is the long run, and this is what the trading pit actually brings value, supporting the traders in order to get together to the next level. So you cannot think of the next level if you're not building up correctly. So far, yeah, we do have a question from anonymous attendee. Is portfolio better for forex and commodity trading, or just normal trades? John.
It applies to both. So forex and commodity trading comprise potential. When we talked earlier, I think when I went to Viability, that's based on the analysis that you do of that forex subcomponent. So let's say if you have a strategy that trades the euro, you have a strategy that trades the yen, and you have a strategy that trades gold. Well, forex, that euro and that yen strategy are going to be part of an asset class, that forex asset class. Okay, and then that commodity trading, that gold trading you do will be part of your commodity asset class. And those are, there are times when those asset classes correlate quite strong, and other times when they don't correlate. For example, we went through a pretty viable stretch where forex trading, was pretty much dead, and we saw very minimal volatility. Where at the same time, crude and gold were moving quite a bit, and that's a function of when central banks were all kind of stuck at zero. FX trading was very difficult, specifically because of the ECB wasn't moving, the Fed wasn't moving, the Bank of England wasn't moving, and so understanding the long-term viability of that forex market, you would have done that analysis and said, okay, that's a tougher nut to crack right now, or I have to adjust my strategies to where maybe instead of being more trend following, I need to be more mean reverting. So that's an example right there. So next question, Alex. I'll try and hit these before we have to pop off.
Yes, Alex actually is asking a question, and I'm replying back to him. He's having a question regarding the drawdowns on the trading pit. This is more technical. I will email you, John, Alex, sorry, with all the details. Joseph is asking if we can have a discount code for your book. We're
Yes.
giving the first 3 chapters anyway now for free. Yes, John?
Yeah, so we're giving the first 2 chapters for 3, and I will come up with a trading pit discount code for everyone. I'll do something like that. Let me give that some thought. I want to make sure, first of all, we got the first 3 chapters out. But we'll come up with something in that regard. Joseph, great question. Thank you.
Great. And Beta Andre is asking, how do you recommend running a portfolio when at every 10% profit you need to restart the challenge on the next level? I think as well, Andre's question, it has to do with the trading pit, right? So we'll give you a brief explanation about that. Here, John was elaborating a bit on a bigger scale and where we actually want to be. You have another question, John. Can we work with ratios which consist only Forex? Usually ratios are for stocks and bonds. Does that work on Forex as well?
Sure. Yeah, absolutely. No. In fact, the example of the Netto number shows the Netto number applied to what is no less than 40 different Forex ratios. So the idea of risking a finite amount to make an indefinite amount is a concept that transcends asset class. So it absolutely applies to Forex, it absolutely applies to commodities, it absolutely applies to the markets. It comes down to, it even transcends the capital markets. It goes into, if you're going to invest in a business, you're going to do a business startup, you're doing that, you need that certain amount of startup capital. The hope is ideally that startup capital yields many multiples or an order of magnitude greater than what your investment is. And so that concept absolutely applies to Forex. And that's the first place we start, because when we think about what drives the monetary cycle, central bank liquidity is, I mean, the manifestation or the reflection of that is done brilliantly in the Forex market. So it absolutely, the Netto number, cut its teeth in the Forex market.
Thank you. I don't believe we have any more questions so far. So we are right on time. Alex, I am saving as we speak your email, so I'm going to come back to an answer to you. John, one more time. Thank you very much. That's really impressive. Start touching the big picture here. Andre, also, I'm going to be replying. I already replied to you, but any questions, any further questions to anyone, I'm dropping my email here so you can ask. You can send your questions at me. I will speak with John and we're going to come back to an answer to you. As we said, the next webinar, John, now is 11th of December, the same time, yeah?
Yes. And if I can get, once again, I want to thank the Trading Pit for this gracious platform. And again, whatever the charity is, for me, rebuildingwarriors.com. They donate service dogs to military veterans. If you check those out, or whatever local charity matters to you. I just thank the Trading Pit for giving me the opportunity to bring awareness to these important causes.